Today is our first English episode because Ben, unfortunately, you don't speak French. You're from Quebec though, right?
I live in Quebec. I'm from British Columbia.
Okay.
Which explains my lack of French, at least partially explains it.
But you do speak Spanish a bit, I heard.
Don't test me.
Okay.
More than I speak French, though. Yeah.
Anyway, investment returns, it's in numbers, not in letters. So if you don't speak English, we're going to add some captions and it's going to be in French.
Yeah.
Ben, thanks for being here. For the Quebecers who don't know you, can you do an elevator pitch in 15 seconds?
15 seconds. I'm the Chief Investment Officer at PWL Capital, which is a Canadian wealth management firm. We manage about $8 billion for Canadian families, businesses, and other entities like not-for-profits and stuff like that. I think I'm over 15 seconds. I also co-host the Rational Reminder.
That was my question. Like you have a podcast, Rational Reminder. You also have a big channel on YouTube. I think more than 600,000.
Yeah.
Are they real people?
I think so. I get lots of engagement and comments, so I'm pretty sure they're real people. But yeah, so Rational Reminder podcast, which is usually in the top 10 business and investing podcasts in Canada.
Yeah.
At least based on the Apple podcast charts. And my YouTube channel has 600 and something thousand subscribers, and videos get usually between 200,000 and 300,000 views.
Congrats. Congrats. It's been like 7-8 years you do that?
Yeah, eight years.
Wow.
Okay. And so the podcast is your main like lead acquisition channel, is it?
It's a big part of it. So we were just looking at these numbers actually earlier today, and it's say roughly a third of our people that contact PWL because they're interested in our services have come through the podcast or my videos.
Huh.
Speaking or other content. We do white papers. We create free online tools for people. So those drive some traffic too.
Okay, so we have a bunch of questions. We're going to go from AI, scams, media, youngster, stock picking today.
Yeah.
You said the word big. You're 6'10".
Yeah.
Maybe more, like more than 2 meters. Do you think you're too big to fail?
That's a ridiculous question.
There's no answer to that.
What I will say is that there is a correlation between height and income. That's a real thing.
Yeah, that's
really?
That's a real thing.
Yeah.
So I don't think it guarantees a high income, but it seems to help.
Should we launch a tall CEO ETF? I would be curious how it performs, like based on.
It's actually interesting. If you look at the heights of Fortune 500 CEOs, they tend to be a lot taller than the average person.
I think it's 6'2" or something, 6'3".
Something like that.
Yeah, I saw that.
And the proportion of people who are even taller than that is much higher than the population. So I would say that height is already priced in.
How do you think media influence investing? Do you think it overcomplicate simple investing? Because you said in one episode that pretty much investing has been solved. Can you walk us through why you said that and how media influence the people?
I have said that investing has been solved. And what I mean when I say that is that anybody can buy a low-cost index fund. In Canada, we have asset allocation ETFs now, which are you buy one ETF and you get an automatically rebalanced, globally diversified portfolio. That's like you're going to beat 90% of professional money managers investing that way.
Yeah, that's amazing.
And so I call that solved. Like you don't really need to do anything else. It's a solved problem. You can try and optimize, you can try and do things around the edges, but like you're 90 or even more percent of the way there with these super, super easy to use products. So investing has been solved. Now, the media can't say that. Like if you're a financial journalist, you can't just say every day.
And you wouldn't have any podcasts and nothing for us to talk about.
I don't know. Like we always say that investing's been, our message never changes. We don't tell people to do different strategies or whatever. Usually what we're doing is explaining why, despite whatever this thing is happening over here or whatever new product has appeared, why investing is still solved, why it's still the same thing. You should keep doing the same thing. There's a lot of content there, but I think, financial journalism, more generally speaking, and there are lots of great financial journalists, but just saying the same message every day that investing has been solved is pretty boring. And so they write about other stuff. And when they write about other stuff, it, I think, often makes investors think that they should be doing something. And I don't love that.
So why do we spend so much time following GDP, employment, recession forecasts, stuff like that?
I think to be clear, that stuff does matter to the world. Like those are numbers that will have downstream impacts on our daily lives, or at least they can. From an investment perspective, they are just priced in is the easiest way to to describe it. Like all of the effects that we see on economic numbers are already reflected in stock prices.
Why is there people making alpha, so excess return compared to like the benchmark in the markets if everything is fully priced in?
People can make alpha. Like even if we just, and I'm not saying this is the case, but even if we just assume that all active managers are just randomly picking stuff.
Yeah.
And that's not always true. In some cases, it probably is true.
Yeah. We spoke about that.
It's true about us.
But if we just assume everyone's randomly doing stuff and everyone thinks they're going to beat the market, there's going to be a distribution of outcomes. Some people, just by sheer luck, will outperform.
Right.
Most people will underperform. And the reason most people will underperform is something called skewness in the distribution of individual stock returns, which just means that most of the market's return comes from a relatively small number of stocks. Yeah. And if you're picking the 20 stocks that you like for whatever reason, there's a very high chance you're going to miss the top performers that drive most of the market's performance. But the index, the market, always owns those stocks by definition. So you're going to capture the market return with an index fund. But if you're picking stocks, there's a high probability that you won't. And then you layer in costs on top of that, and it becomes even less likely for an active manager to produce alpha. The other really interesting question on alpha, because it's a thing, like there is alpha being generated by some managers. But I think the next important question that it's related to the were they just lucky question, although that's not the only explanation. But if we look at managers that have been successful in the past and ask, are those the managers that continue to beat the market, continue to generate alpha in the future? And it's a pretty unequivocal no.
Yeah, makes sense. It's like it's never the same country, like
same
on a
idea.
Period of 10 years.
Same idea.
There's
even
returns.
Some researchers. It's tough.
The question I always ask myself, because that subject we're talking about right now, it's been known for years, but nothing is changing. So do you think the industry or one day people will wake up and be like, why do I need all those products? Why do I need that McKinsey, Fidelity, or whatever kind of investment they're selling? And you should just buy the S&P or triple Q by yourself and your whatever kind of direct brokerage account. So why is the industry still not changing if we know that?
It is changing slowly. So PWL tracks the percentage of total Canadian fund assets that are in active versus passive funds, and the passive share has been rising in Canada. It's still pretty low relative to the United States. The United States has, in funds, the passive share, I think it's surpassed 50% in index funds. So the market is...
But two questions to that. Okay, so if you have past investments, because I've read about that, but if everybody's passive, let's say, in my view, that's where there's opportunity that comes after, because there's dislocation and asset allocation, right? Because there's going to be like an even distribution, but there's going to be companies maybe that are going to be undervalued, but because everybody's fully indexed, it's not going to be seen.
So there's a concept in academic finance called the Grossman-Stiglitz paradox, which speaks to what you're talking about.
Yeah.
And the paradox is basically that markets are efficient because of active managers. But if markets are efficient, active management doesn't actually make sense, and you should just index.
Yeah.
But if that's true, then everybody would index and markets would cease to be efficient. So it's called the Grossman-Stiglitz paradox. I think in reality, it exists as an equilibrium where there are a number of active managers that are managing a certain amount of assets. If we get to the point that you're describing, where markets cease to be efficient and there are obvious opportunities for active managers to capture, they will generate alpha. Investors will see that alpha is being generated and they will reallocate to active management. But we're always in that equilibrium, and active managers are always competing to generate alpha. The challenge for investors is identifying those successful managers before they have become successful.
Yeah.
Because the other thing that we know about active management is that it sows the seeds of its own destruction, basically. When active managers are successful, they attract more capital, but they attract capital right up to the point where they can no longer generate alpha.
True. Yeah. It's like ETF, like Cathie Wood. She was so popular with ARK.
That's an extreme case.
Yeah, well, that's...
Yeah, but you think that's the case with like Berkshire Hathaway, for example? Like if you look at just their liquidity on ends, it's just like, it's tremendous. And even if they deploy, let's say like 10, 20 billion, it doesn't change much at that point. Is that the case?
I'm not sure if I understand the question.
Like Berkshire, like there's it's been such a good business and such a good, like it's almost like an ETF in a certain way ish.
Yeah, conglomerate. Yeah,
ish. But like they have so much capital under management nowadays that it's tough for them to deploy or make as good as move as they did before.
So I used Berkshire as an example in a video that I talked about this topic because Buffett was extremely successful early on. His returns were insane. Because of that, his lifetime returns have outperformed the S&P 500 by a wide margin. But it's been more than 20 years now, if you go back in time and compare him to the S&P, where he has underperformed the index.
Because it's too big, like too much.
Buffett has said that. Buffett has said that in their
You
shareholder
cannot be
meeting.
flexible. But when your main problem is you have too much cash, well, you live a good life, right? Let's put some.
But Buffett's talked about that too. That they've feel a duty to their shareholders to be diligent and protect their capital. But however he describes it, the reality is Berkshire has underperformed the S&P 500 for a long time now.
Yeah.
So it's an interesting question about Buffett is often held up as the example of, well, look, you can beat the market. And he did for a long time, but he hasn't now for a long time. And he's now, of course, retired. At least
and it's one of the best, if not the best. Like if I compare to the people listening to our podcast right now.
Yeah. The best is probably Jim Simons, the Renaissance technology.
But this guy, you know, that.
But for a shorter period of time, right?
No, Jim Simons.
They're still ripping.
The
They're still
Medallion Fund.
Weren't they making like 66%?
They were charging very high fee. Yeah, that's right. And their fees were very high. But so again, speaking to are markets efficient, the Medallion Fund is a fascinating example because they clearly found something.
Well,
and it was persistent.
Yeah, exactly.
But why was it persistent? It was persistent because they kicked out all external investors.
They removed
Only
capital.
Employees could stay in the fund. And they keep the fund at, I think it's $10 billion and remove all excess profits every year.
So if it would have been bigger, more cash, less return.
Correct.
Yeah.
Hard to deploy.
Exactly.
Okay.
And so I think it raises that question of does Renaissance Technologies prove that markets are inefficient, or does it prove that they're efficient? And that there's a little bit of inefficiency, but there's only a little bit.
Okay.
And they found it and they ate it.
But for the rest of us, do you think stock picking is a strategy or a hobby?
In my opinion, it's a hobby.
Okay.
I mean, like I was talking about with active management, the chances of picking the right stocks are pretty low. And some people can do well by it. Some people love doing it and analyzing companies and following the markets, and that's fine. But I do not think it's a good long-term strategy for the very simple reason that your chances of underperforming in the long run are far greater than your chances of outperforming.
But at least it's good entertainment for the podcast.
Exactly. Exactly.
If you had to pick one stock, let's say, no need to mention the stock, but how would you choose it? What would be the rationale behind? Like, what would you check?
I've only ever had one single stock position, and it's always been in my employer.
Really?
I had equity in PWL. PWL was acquired.
You never bought any other stock?
Yeah, no,
I'm skeptical.
I've held some stocks in my brokerage account, but like as a long-term, like I'm going to hold this for a very long time.
That's interesting.
It's been, well, two stocks, I guess, PWL, and then we were acquired by a firm called One Digital, and I rolled a bunch of my PWL equity into that.
Okay.
And I don't necessarily think I have special insight. I mean, with PWL, we had intentionally priced ourselves below our market valuation because we wanted to transfer equity to the next generation of employees. So in that case, I kind of knew we were undervalued. With One Digital, it's a little bit less obvious because they have institutional investors and stuff like that. But I own a meaningful position in that stock, and likewise with PWL, because I'm spending a meaningful portion of my life contributing to that business. And I just was never comfortable doing that where I did not have equity exposure to the thing that I was working on and contributing to.
Well, that's a good strategy, like of stock picking when you actually work there.
Yeah.
Now they're private companies in both cases, so it's they're high risk, and I understand that. I'll be okay.
Well, it's kind of the same for me. Shopify has been my best investment so far, and then this is how I made my money as well, selling Shopify apps. And today's a good day for Shopify owners.
It is.
Let's say I'm passive. I buy ETF or funds. How much of my portfolio should or can be allocated to play money?
It's subjective. Like with clients, the way that we approach this, and not always with play money, but in many cases, it'll be an employee of a company. Say it's Shopify, and they've got a bunch of equity from working there, and they come to us and they say, how much should I diversify and how much should I keep in my employer stock? And a lot of people that get employer stock, I mean, similar to me, I guess, they want to keep some exposure, which is interesting. And even for me to say that, it's kind of funny, right? Because an economist, like an academic finance person, would say that you should never have your income and your investments coming from the same place because it's a lot riskier.
They should say that to SpaceX employees, maybe.
Yeah. Yeah. Ouch. That's a tough one. So what we usually tell to people in that type of situation, and I think it applies to play money too, is that if you have enough diversified that you can achieve your financial goals, the rest you can do whatever you want with.
do you see some change coming forward in this industry of wealth management, because more and more people are getting like, oh, okay, now I can just buy that thing by myself and keep it for 20, 30 years and probably going to beat 95% of the people working at the bank. Do you see that kind of shift in mindset or generation like shift? Because I think like if I look at my parents, for example, they're not thinking like that, but I know a lot of people my age are thinking like that. So if there's going to be any that transferation of money in the next few years, is that going to be an issue, you think?
So I think two things have happened in the wealth management industry. One is what PWL has done, which I can describe, and the other is going in the opposite direction, where I think a lot of investors have come to understand that the traditional high-fee actively managed mutual funds that many Canadians have historically invested in and still invest in today are not good. And I think a lot of people, not everybody, because there's still a ton of assets in those products, but a lot of people have come to understand that.
Yeah.
And so a lot of the wealth management industry stopped using those actively managed mutual funds and started going into more esoteric alternative asset classes like private equity and private credit and private real estate and all this kind of stuff, to make it seem like, well, hey, you should come to us because we have these really fancy portfolios. I don't like that. I don't think it makes sense. And I think it's ended up being actually quite problematic for a lot of the people, the end clients who invested in those products, because we've seen over the last couple of years a lot of liquidity issues where private funds have had to gate redemptions, which means clients can no longer get their money out just because the underlying assets are illiquid, which is something clients should understand when they go into those products, but it doesn't seem like they often did, because a lot of people are pretty mad.
Well, they don't know about it.
Maybe, it wasn't disclosed properly, or they didn't understand it when it was. So that's happening. I don't think that's the right direction to go. Where PWL has gone is more in line with one of the things that you said, which is focusing on financial planning, focusing on things like tax estate planning, making sure people are setting the right financial goals, which seems like an obvious thing, but there's really interesting research on whether people are able to identify the objectives that are important to them. Like if I asked you guys right now, what are your financial goals? You give me an answer. If I later presented you with a whole bunch of financial goals that have been important to other people, there's a high probability that you would realize, oh shoot, that goal is actually really important to me.
Yeah.
Well, at first I had no answer to your question, so I would probably pick some of them.
So we spent a lot of time doing research on this. We worked a little bit with some of the top researchers in objective setting in the world. We had them on our podcast and kind of went back and forth with our process for goal setting. So we've created this structured goal setting process that we use with clients. But stuff like that is like, I don't think most of the financial services industry is thinking that way, but I think there's a huge amount of value there. And that cascades down to other decisions, like what should your asset allocation be? How much should you be saving? Should you be gifting to children now or later? Yeah. Should you keep working?
Yeah, the stuff that matters. Yeah.
All kinds of big stuff that comes from that, which affects investment recommendations, which is ultimately what we're here to do. But I think it's allowing us to add value in a way that's not how most people are thinking about it. So that's one. That's like objective stuff. Like we're doing things that are objectively valuable for clients. The other part of it, and we've actually just recently started interviewing clients to ask them what they value about the relationship with PWL. And the thing that's come out of that I think we kind of knew implicitly, but it had never been articulated so explicitly, is that there's a huge amount of peace of mind that comes from having a relationship with someone that you trust to give you good objective advice when you need to make important financial decisions.
Yeah.
And so that just offloading the mental weight of worrying about your finances seems like it's really important to people. And
it is.
Right.
Yeah.
And I think that comes from being a trusted resource. The client knows that you have their best interests at heart. They know that you're going to do the proper analysis before you give them a recommendation or advice. And that takes a huge mental load off of their plates. Well, one interesting anecdote is that, like we talked about earlier, a lot of people come to us to be clients because of our podcast. So they'll listen to some people go back and listen to every single episode before they reach out. And I'm like, wow, that's like
7 years of episodes.
But they do it.
So they came with a plan and then they're like retired. Oh, well, the plan has changed.
Yeah. They listen to it on 2X, I guess.
4X maybe.
4X. But they come and then they'll say, I love your podcast. And then they become a client. They have their financial planning work done. They get the advice. The portfolio gets implemented. And then the next time I see them, they'll say, I don't listen to the podcast anymore because I just don't feel like I need to because this stuff is taken care of. And I find that to be really,
but that's a good
insightful.
trade-off.
Yeah.
You lost a free listener for a paid client. So.
Yeah. interesting difference is the difference between the RRSP and the TFSA.
Okay,
Where
what
the
is it?
RRSP you contribute with pre-tax dollars,
Right.
and then you're taxed later. And so you're in that case deferring the tax liability.
And you can open both yourself
Yeah.
online if
Yeah.
you use the app of National Bank Courtage Direct.
Yeah.
Okay, that's nice.
The really interesting thing. Do you want to do that?
Yeah.
Okay.
Let's go ahead.
So with if you take the RRSP and the TFSA, the REER and the CELI, a little bit of French. Yeah.
Pretty
Je
good.
m'appelle Benjamin.
Yeah. Je m'appelle.
Yeah.
If you assume the same tax rate, the total tax rate. Now
Okay.
that includes the actual taxes you pay to the government, but it also includes government benefits that may or may not be clawed back based
Right.
on your tax rate.
Yeah.
So the same tax rate when you contribute and when you withdraw. So we've got now the REER and the CELI, the RSP and the TFSA. If the tax rate stays the same, the after-tax result of using either account is going to be the same. Which I think
Exactly the same.
exactly the same.
Okay.
As soon as there's a difference in the future tax rate, if the future tax rate is lower, and again, that includes the actual taxes that you pay, but it also includes government clawbacks, like if you have OAS clawed back or whatever it may be, or GIS when you withdraw. If your future tax rate is lower on the RSP withdrawal than it was when you contributed, you have an advantage over the TFSA, over the CELI. So when people are thinking about should I contribute to the REER or the CELI, the RSP or the TFSA, they should really be thinking, well, a couple of things. One of the things they should really be thinking about is their current tax rate relative to their expected future tax rate, which they can't really know. But if you've got a really high tax
Usually
rate today,
it declines.
there's a pretty good chance.
Right.
And there's other stuff too. Like in the future, you can split RIF income with a spouse in some cases. So that there's a lot of reasons why you should expect your future income to be lower, and therefore the REER can be a better option. But the other issue is liquidity. You don't really want to make an RRSP withdrawal in the interim. If you contribute this year, you probably don't want to take it out next year.
Right.
But the TFSA, the CELI, when you take money out, you get that contribution room back the following year. So it's a lot more flexible.
Yeah.
It's probably the most relevant and deep mid-roll we ever had. I'm going to continue in French. Vous allez sur l'application Banque Nationale Courtage Direct, bncd.ca. Le lien dans la description. Vous pouvez vous ouvrir un CELI et un REER vous-même. bncd.ca.
I don't know what will happen with financial markets with respect to AI, but if we look at the historical track record of transformational technologies with respect to investment returns, it's not a very good track record. There's a very consistent pattern with major technologies, and there's been a bunch of studies on this. And what tends to happen is that the economy and like people recognize that whatever the thing is, whether it's railroads, the internet, electricity, all that kind of stuff, automobiles, people realize, like, wow, this is changing the world, and it's going to change the world in ways that we can't even yet imagine. But everyone kind of gets it, and everyone goes a little crazy, gets really excited about all the possibilities. And we've seen this with AI recently. The asset prices for the companies in that industry go up a lot, and those are called, in some of the research on this, they're called major technology bubbles. And then what tends to happen is that as the technology gets installed in the economy and the actual economics of the business starts to be observed, typically the price comes down a lot. That's why it's called a bubble, because it goes up and then pops and comes down. And the end result is that the returns for investors are pretty poor, especially if they invest at the peak of the bubble or near the peak of the bubble.
So would you say right now in your the metrics you're looking at, would you say there's like kind of a bubble kind of situation?
I'm always hesitant to call it
Is
a bubble.
it priced efficiently?
Because last month, if you just look, I was looking at Micron SanDisk for like two leaders in the industry. Micron was down like 35, SanDisk like minus 55. But I mean, if you want to diversify, you buy the S&P 500, but you're still exposed to roughly 35% of your portfolio to those companies. So are you really protected in a certain way, even if you're diversified? So how to really get yourself out of this bubble if there's one?
Yeah. Okay, so is there a bubble? I'm always hesitant to call it a bubble ahead of time. It's easy to call it a bubble in hindsight, which is why I think with the major technology bubbles, we can see, well, it went up and it came down. That was, we can call it a bubble. Before the fact, though, you don't know. Prices don't have to come down, which is why I say I'm hesitant to say what's going to happen with AI-related returns. So bubble, who knows? When prices are high, though, we can say, forward-looking, that expected returns are low.
Yeah.
So if you look at the U.S. market, the valuations are getting close to as high as they've ever been. like in the tech bubble, which again we know in hindsight was a bubble.
So 10 years from now, because we're relatively at all-time high, return should be lower than if we weren't that high.
Mechanically, like the market is pricing lower expected returns. Or, I mean, this is where it gets a little bit tricky. The market could be pricing lower expected returns, or it could be pricing really, really high future cash flows. In either case, because the market tends to overestimate future cash flows in situations like this, in either case, it points to lower expected future returns.
Yeah.
So I think that we can say that reasonably. On the diversification thing, yeah, it's a tough one. Indices are concentrated. The U.S. market index is as concentrated as it's ever been, maybe even more than it's ever been in the past. Past periods of U.S. market concentration have not led to market crashes or total disasters. Past periods of Canadian market concentration, which have even been more extreme than the U.S. market, we had like a third of our market cap was in Nortel at its peak.
Yeah.
And it properly busted.
Yeah.
Like that was, it went to zero eventually. And the Canadian market was actually pretty resilient in that case. So index concentration seems like a really bad thing. But if we look at historical periods where markets have looked concentrated like they are now, it hasn't been that bad.
20 years from now, there's going to be more capital, more liquidity in the system. So, we've been printing so much money the past few years. So it's kind of hard to see like assets prices going down if there's so much cash. And I was even looking at the like used car market. Okay, for like, I was reading an article on that on like Ferraris and collection cars. And apparently there's like private equity people buying cars now because they just want to protect their capital at any cost. So I was like, that's crazy. You can buy like a GT3 RS like that. The car costs like 350 grand. They're listed like 2 point something million on one side. I was like, that's insane.
That's
so it was
crazy.
like, I feel like there's so much money that it's tough seeing those asset classes going down and even the market going down that much. Is that something that you think is possible? Or?
I think the money printing mechanics are a lot more complicated than people give them credit for. Like, I don't know if it's necessarily right to say that, well, the central bank printed money and therefore asset prices went up. Maybe some relationship there, but does that mean asset prices can't go down? I don't really think so. We also have to think about what it means to say that the central bank printed money. Usually they're swapping one type of government debt for another type of government debt.
Yeah.
And we call it money printing, but they're just changing the duration of the debt market. They're not really changing the amount of liquidity that exists.
Yeah.
Yeah.
But maybe the ones you were talking about, they just wanted to pump the Carvana stock. That's why they buy like 200,000 cars for 2 million. Let's talk about youngster. Oh, you wanted to go?
No, it's good.
You've argued that young people may be saving too much. How come?
I don't know if I haven't quite argued that. I think the argument that I've made is that economic models suggest that young people should not necessarily be saving. Now, are young people saving too much? I think is probably not true. I think if we looked at the data on what young people are doing, they're probably doing something similar to what the economic models predict they would be doing, which is not saving very much. And I think I've taken some heat for this.
That's why I was asking.
Because I think, and it's, I don't know how true
because
it
when
is.
you say that, it sounds like it encourages like to spend a lot
let's go spend.
and not save.
Well, when I've said that, I've been pretty careful to say you still need to save. Just, I think that there's almost there's like a pathological level of saving that sometimes gets promoted, especially in like the type of circles that listen to podcasts like this and listen to my podcast, like the nerdy personal finance people are encouraged to save a lot, which is not necessarily a bad thing, but there are things that you can spend your money on that improve your life. And doing that is not always a bad thing. And I think people who go to the extreme levels of saving view any spending as a bad thing. And I think that that's probably detrimental overall. For young people in particular, when they don't have much disposable income, small things like living in a slightly better area in the city that they live in, or buying healthier food, or paying for a gym membership, those are all things that can meaningfully improve their life relative to saving an extra $100 a month or $200 a month.
Instead of putting cash under the mattress, you should buy a good mattress, right?
Yeah, right.
No,
that's a very.
But let's go a bit further. Should you recommend, or let's say, should some young investor borrow to invest?
Yeah, so I'm always super nervous about talking about this one because, I mean, similar to the saving thing, like people hear that you should borrow to invest and then they'll go and borrow to invest, and it's a very risky thing to do.
Right.
So I'm hesitant to say everybody should do that. But again, if we look at what do economic models suggest, they do suggest that young people probably should be borrowing. And the reason is pretty simple, is that the amount of equity exposure that a young person should have throughout their lifetime is pretty high. Like the proportion of their future savings that they'll eventually invest,
Right.
The proportion of that should be invested in stocks is pretty high. But if someone has, I don't know, $2 million of future earnings that will eventually be invested throughout their life, but they have $10,000 today, investing that $10,000 doesn't get them anywhere near to their ideal equity exposure.
But how can they know that they have 2 million down the road?
Yeah, and you don't. But it's probably more than $10,000.
Right.
Right.
Yeah.
Right. And who makes the research? The banks?
This research? this doesn't come from banks.
Okay.
But there's lots of different ways you can get access to leverage. One is borrowing from a bank. You can use financial products, like you can use options and things like that to get leverage. But again, like should people be buying options to get leverage exposure to equities? Probably not.
Yeah, tough. Tough bet.
So I think it's like theoretically it's a good thing. We had Robert Merton on our podcast a while ago. He's a Nobel Prize winning economist who's done a lot of work on this topic on it's like called life cycle asset allocation. And he agreed that young people probably should have some leveraged exposure to the stock market. But he said in his ideal situation, it is built into a financial product. Like you buy an ETF that gives you exposure to leverage exposure to stocks, because then you're not
rather
risking,
than taking the leverage yourself.
Correct.
Right.
Because you can really mess yourself up on implementation if you do it yourself.
Yeah,
but if you're buying a leveraged ETF,
Or leverage ETF really good because of that, from my experience, I mean, I've had only losses.
Yeah, but you were a lot leveraged like when you started.
Huh?
You leveraged yourself a lot when you started. You were trading some
Yeah, I was leveraging
Was it a 3x inverse ETF?
No, I think it was more than that.
No, I was doing futures and all that stuff.
It can go.
But like the
problem,
it's just the leverage ETF themselves. I've never had good experiences with them, like HOU, all that stuff. Because if there's a market, once the market closes, especially nowadays with the moves, and after you have like a gap. It's like a thing. It's the contango effect.
Yep.
If I'm not mistaken, and I almost get squeezed. Always get squeezed.
Yeah, but it's also like it's so volatile. Let's say SanDisk multiplied by 3. SanDisk goes down 40%. You lose everything, right? Like
yeah.
But like nowadays they do like the leverage single stock ETF.
Those are ridiculous.
Crazy.
Yeah, that's what I was.
I did a video a while ago.
I don't even know why this is legal. Honestly,
I don't know either. I
also
don't
noticed that these are the ones that advertise the most. Do you think the ones that are advertising the most are the most dangerous?
Yes.
Yes.
The most profitable investment, and it should be obvious when you hear it.
Right.
The most profitable investment products for the company selling them are the ones that they're going to advertise. The most profitable products for them are almost universally going to be the worst products for you because there's a high profit margin built in for the company selling them. And I think single stock ETFs are one of those.
What about the covered call strategies that sometimes we see for like?
I think it's the same issue. So they tend to have higher fees. I think they do get pushed pretty hard.
They look pretty appealing at first, but when you dig in them, like,
they do look very appealing.
Yeah.
It used to be one of the most requested topics for me to cover. And I was never interested
because it's so advertised. I downloaded the app Blossom so many ETF. And I think we spoke with the guys at Blossom. They said like most of the revenues are coming from ETF.
That's
ads.
Their business model. I hope. I mean, I know those guys. I spoke at their conference.
You cannot say that. We'll cut
I have no idea. I don't know what they've told me. I'm assuming they've told me things that are...
But I know the same as you, so I guess it's
so their revenues come
public.
from financial product companies. So their whole business model...
But that's fair. I mean, they have a social network. So.
No, it's fine. So they get users on the platform. They pay pretty meaningful incentives to influencers to get users on the platform. So you guys could make lots of money referring people to go onto Blossom if you wanted to. And then they get users on there, and it's interesting. There's people having discussions, like it's a proper social platform.
Yeah.
But then they sell advertisements to those people, and because they have such a captive audience, and because you can actually see what people are investing in, it's a very attractive marketplace for product manufacturers to advertise the products.
Yeah, all the portfolio are public. So the data
Correct.
is there.
So it's an interesting business model. It's always made me a little bit uncomfortable, which I have told those guys, so I don't feel bad saying it.
Okay.
I did speak at their conference a couple of years ago, which was fun. But yeah, they at the conference there were a ton of covered call funds being promoted.
Yeah.
So anyway, I think it was before I went and spoke there. I had already done, but I did three videos on covered calls because I did one, and I was like, people kept asking me to do it, and I was like, this doesn't seem that interesting, but I did it. And it was probably more, it elicited more emotion in viewers than videos that I've done on home ownership, which also makes people go crazy. Dividends, same thing. Covered calls, man, it made people go nuts. And so
That's the verdict on those. So
Well,
good, bad. Should I buy this tomorrow?
I have referred to them.
I'm so emotional. I just want to open my
Wait,
phone.
I'm coming back.
We're going to cut this podcast. I have something to do. I think my wife is calling.
But you know why it makes people so emotional is because these things pay, like you said, they look attractive, right?
Yeah.
They look attractive because they pay really high income distribution.
it's an
yields.
income.
And so
Yeah.
you get a
You don't have to
12%
work.
distribution. That's it. Seriously.
No, yeah,
So
of course.
people think that they're getting a 12% basically guaranteed return.
Yeah.
And they think, wow, I can retire early. I never have to work
But
again.
the income comes from the lack of retrons, like the growth of the
So
stock.
the way that
I mean,
covered,
it needs to pay from somewhere, right?
the way that it works is that the ETF owns stocks, an index or whatever. It writes call options on that index. So it's selling
Yeah,
call
premiums.
options. So other people are buying those calls, which means that if the price goes up above a certain level, the people that bought the call will exercise and they get the profit, which means you lose the profit.
Yeah, because you collected the premium
Correct.
as a revenue.
And so you're capping your upside. So you're getting this income distribution by selling the options, but you're giving up the upside on the underlying. And what tends to happen is that because markets are volatile, markets drop and the value of your asset drops. And then you keep writing options. But then when markets recover, you don't participate in the upside. And this keeps happening again and again and again over
Yeah,
time. So you're getting these big income distributions, but you're capping your upside every time markets go up. And so if you look at, I've looked at so many, because every time I did a video on this, every time people would say, well, if you looked at this ETF, you'd see that it's better. And so I did so
if
many.
you look at this specific stock in 2010, right?
So I would do it. I'd be
Yeah,
like, okay.
I get it.
I've just,
Do you think focusing on income instead of total return is a mistake?
that is the mistake that people who invest in covered call products are making. If you look at the total returns of a covered call ETF relative to the total returns of its underlying, they will almost always, and I say almost because maybe there's one out there that has outperformed. I don't know.
And there will be in the comments.
Well, I haven't found one yet.
Okay.
Every time someone would say, well, this one outperformed, you have to look at that one. I would go and look at it and had underperformed. I'm like, man, people just like they don't know how to calculate the total
Yeah.
return, I guess. I don't know.
But it's kind of sexy to tell your friend, hey, you went to work to, let's say, earn like $500, but today, this is how I made with my covered call.
It is very sexy. And I think that's why people get so upset when I tell them that they're probably making a mistake.
What's the most heavily you think like marketed product in Canada? Is it like still the call the one
most
that we
heavily marketed product in Canada? I don't know. Be interesting to see analysis on that. I wouldn't be surprised if it were private assets. But I don't even know how you would determine what the most heavily marketed. I can tell you from where I sit.
We think about it because earlier you said you said about like marketing. The more they market it, the more money they make.
Yeah.
There was a trend a few years ago. It was the ESG like kind of investment.
Oh yeah.
And that
We don't
didn't
talk
really.
about this anymore. Like,
No, that didn't.
Nobody talks about it.
But it didn't do well.
Well,
Not really. Actually.
yeah. So we were always
You're right.
very cautious about ESG. I made a few videos on that. Man, do you want to talk about ESG for a second?
yeah.
Yeah. We're probably gonna get some comments on that, but
It's so interesting. So, I mean, what are the problems with ESG? You end up losing diversification because you're cutting out a whole bunch of companies, whatever. That's fine. Maybe you feel good about that. By nature of people wanting to invest in those types of stocks because they feel good about it, just by nature of that, if a large group of investors have what's called a non-pecuniary preference, like a non-financial preference for something, that will reduce the expected return of that asset. A whole bunch of people want to own these things for reasons other than risk and expected return. The expected return must go down. So we would always explain to people that, okay, if we're going to invest in ESG, that's fine. You should understand that one of the implications is that we should expect a lower return. So that's one thing. There's a paper that came out a few years ago now. We had one of the co-authors on our podcast, and I gotta remember the mechanism, but he talked about how ESG investing may actually be counterproductive. And the mechanism was that brown firms, so like the opposite of green, if you starve them of capital, so that's the other argument. By investing in ESG stuff, you're starving brown companies of capital. So you're making it harder for them to get access to capital, which you might feel good about it as an ESG investor.
Yeah.
But what's interesting is that what they observe in the research that they did is that green companies, so they get access to lower cost capital, which again, to reiterate, as the investor means you have a lower expected return.
Right.
Green companies that get access to lower cost capital, they can't really get greener. They're already green companies. So they don't go and make themselves greener. So that nothing changes. Brown companies, when they're starved of capital, they don't turn around and get greener. They lean further into the profitable brown activity. Right. They get darker brown.
Yeah.
So that's an interesting angle. So you've got lower expected returns. Right. You've got the potentially counterproductive component. And then the other issue, and this one's so tricky, is that there's no universal definition of ESG. So a client says, I want to be an ESG investor. It's like, okay, well, there are 5 different ESG index providers and all of them have different definitions.
Right.
It's like, okay, well,
the only definitions I have is economic, social, and governance. Like,
right.
I mean,
but everyone defines those differently and they put different weights in the criteria.
Huh.
So we've had cases where a client's like, I want to avoid these specific types of companies.
Some financial advisor, they usually always beat the index. Well, what index in what country? Well, that is changing over the years, but they beat it. Right?
Yeah. Anyway, so I agree.
Okay.
ESG was marketed very heavily for a while.
Yeah.
And I think it spoke to like people were feeling like they wanted to support the environment and they worried about climate change. That's one interesting angle on ESG is that it could act as a hedge against climate risk. So if climate change stuff ends up being worse than we currently expect it to, you might expect ESG to outperform. But because of that, because it has that insurance component, you also expect lower returns in normal times.
Right.
So it's like buying an insurance policy
like
against,
insurance.
right.
Yeah. Makes sense.
Anyway, that's all my thoughts on
if
ESG.
there's a big climatic impact, they will be impacted too. I mean, if the level of water go that high, like it's not because they're green that they don't.
Well, if climate stuff gets worse and people start choosing green products more
Now I get it. Not the business itself.
Yeah, not its
capital.
physical building. Yeah,
I get. You also said that young, high-income men that understand finance might be vulnerable to bad financial products. Can you explain that?
Yes, that's
so. Am I vulnerable to bad financial products? That's the real question now.
I feel like you're probably like over the hump of overconfidence. Would be my guess. So
but
I think
it's also dangerous, right? Like if I know finance, to turn into overconfidence. No.
Well, I don't know. I don't know you well enough. But I feel like if you guys seem pretty thoughtful. You're spending a lot of time. You're doing this podcast. Like my guess is that you have more than just a passing interest in finance.
Yeah.
And my guess is that you're past the level of overconfidence, and you probably have some level of
overestimate me. Don't overestimate.
Okay, my confidence in your confidence is decreasing a little bit.
No, but I was afraid to become a worse investor because I start to know more.
Yeah. So I think there is. And it depends on the type of education that you're getting. I think that there's a lot of information, if you go looking online, that tells you how to pick stocks. It tells you to use this app to pick stocks. It tells you how to analyze stocks. It tells you how to read financial statements like Warren Buffett. All of that stuff, in my opinion, and I hope I can say this, is complete bullshit.
Okay. So I bought all those books for nothing. That's good.
I mean,
I've read them too.
Yeah.
Okay. But it's good. It's good to know what fundamental analysis looks like. It's interesting to know how to analyze a company. It's kind of good to know what all of the analysts are out there doing. I remember I was on the student investment fund when I was doing my MBA, and I was tasked with putting a price on Apple stock. And so I did a big DCF model. It's super cool. Like I had a guy
Mark
who...
too.
I used to be in the investment fund too at the university. So.
Okay. Yeah. I love that experience.
Those like come stables. And,
And it was awesome. I enjoyed it. But I remember doing the DCF model for Apple, and I remember changing the discount rate by like a basis point.
Yeah.
And the valuation would swing wildly. And I was like, how is anyone putting a price target on this when like this makes
how
no
they
sense.
Do it.
Yeah.
They
it's
get
crazy.
to the price that they wanted.
Right. And you can change
how
it
much
by
do you want to pay? Okay, we'll get those numbers.
actually though. So for me, that was like I
But this is how all of the finance industry works when you think about it. Like
Yeah.
investment banking, M&A, all that stuff is like, just like those numbers. You
My
want this?
business is
I want
worth
this.
that many billions.
No, but it's like,
M&A's crazy.
Yeah, it's a room of
M&A's
thought.
very much
Yeah.
like
Yeah. It's like, how do you pick those numbers? The assumptions that you put for growth, and you're like,
it's often just
Questionable.
multiples.
But
Like this is the multiple that this industry uses, and we will
Yeah.
use that valuation. And then
Yeah.
it's all about figuring out what the EBIT is.
But that would mean I could buy a great business and it still be a bad investment, right? Based on like the metrics that were calculated by some analysts, or even if the business is going well.
Well, I think yes, but I want to stay for a second on young men.
Yeah.
I think the issue is you get a little bit of knowledge, and maybe you do a DCF valuation, you feel pretty smart. Maybe you do a DCF and your price ends up being the future price, and you're like, oh man, I got it.
Yeah, I got it. Did you get it on Apple?
I don't remember.
I'll forward
I don't
you.
remember.
But it's funny you say, me too, because I used to, I was like, first time I read The Intelligent Investor, I was like, I really need to understand that formula. So I was reading all the books, like, what's the secret sauce they're using at like Berkshire? I was running those DC.
Yeah.
It's also funny. I read the first 25 pages and I threw it in the trash. It's like, this book is too big. It's just too big.
Well, even Ben Graham later in his career, he eventually did say that he thought that a more systematic approach to investing probably made sense. So like throughout his life, he wrote about fundamental analysis and how to but by the time he was getting later in life, like I think one of his last interviews, he talked about how like maybe the old school way of doing it doesn't make sense anymore. And that was a long time ago.
Yeah.
Now.
Right.
Yeah. Anyway,
Because at the beginning, he was buying good businesses at a bad price, right?
Yeah.
And then Buffett said, no, let's buy great businesses at good price. And Ben said, well, maybe you're right. Or,
but then eventually he said, maybe we shouldn't be doing any of this, and we should just be systematically buying companies with low prices
Right.
and high profitability.
Yeah. Yeah. Sorry, you didn't finish.
Yeah,
the
so
point about-
young men, the research on this does suggest that those types of investors are more likely to fall for scams. They're more susceptible to financial bullshit, which is an academically defined term. And I think the reason is just overconfidence. Like you're smart in some domains and you think that's going to translate to investing, but it doesn't tend to. Crypto is another one where a lot of people who invested in crypto were young men with high incomes who
I
are
can
probably
imagine
pretty
myself
smart.
falling for that. Like you tell me good stuff, I feel good, my ego.
Yeah.
And
Yeah. But do you feel sometimes like it feels like you read a lot? So, I mean, the more you read, do you feel like the less you know, or not really?
For me, yes. And I always hope that I can look back every year on myself the previous year and feel like that guy last year was an idiot.
Yeah.
I had a bad year if I can't do that.
Did he have a better return than you now? Like, I'm also asking myself, I feel I'm smarter now, but the guy 3 years ago was performing a lot better. Should I go back to this guy?
I mean, investing like you know nothing. And Buffett used to always talk about the know nothing investor. That's basically just buying index funds. If you know nothing, you buy index funds. And that's, as I've said a couple of times, that's probably the best strategy for most people. Good companies, are they always good investments? No. There's a really interesting, I think it's a book published by the CFA Institute on this, which is like, do the companies that people generally perceive as good businesses tend to perform well as investments?
The answer is no.
The answer is no.
Right.
And it's because they've got high prices, because investors hold them in high regard for whatever reason, which drives their prices down. So it's really finding some random company that nobody knows about, that if you were to pick stocks, which you probably shouldn't be doing.
Yeah.
But some random company that nobody knows about.
But you're right, because people in the comments, they ask like us, hey, talk about Costco, Walmart, all those companies worth like 50 times PE ratio and stuff like that. And we're like, I don't want to tell too much because I feel it's
you're all thinking about those good companies, and we're thinking about waste management.
I'm usually digging into companies people don't know, and he laughs at me about that. But anyway, I was also looking about mega stock. Like, I feel like now they're behaving more and more like penny stocks, like the volatility, the price movement. Do you think penny stock will become less popular? I mean, you don't need penny stocks anymore to have those swings. If you go,
I don't know. I don't follow the penny stock market very closely, so I mean, I don't know.
Because every time let's say I'm at a barbecue, someone say, I went to the tennis, like Banque Nationale, and I ordered ice cream for my son, and he said, "Hey, you do the Investi podcast. What do you think of this company?" I was like, "Oh man, that's a penny stock." And like, I mean, I cannot tell you anything, but why are you in the penny stock? Well, my brother-in-law told me like it could 10x.
It always starts like that.
Yeah, but
always.
Nvidia could also 10x, right? Like, I don't know. Like,
I got this guy who told me like, okay, from this guy.
Yeah. And at the end, I was like, is it free, the ice cream, or it's still $8 for my advice? No, but I mean, I don't know. It made me
I don't
think
know.
of...
I think that there have been some like Nvidia was nuts. Even Tesla's had a pretty crazy track record. But yeah, there are some pretty interesting companies. I don't know if that's a new phenomenon, though. I think there have been large companies that have had crazy returns. We maybe used to hear about them less.
Right.
Like some of these recent companies have just been so public and so large and so sort of well known as product providers in the real economy. Like people knew about Nvidia because they bought computers and they played video games and whatever. And then its price went crazy because of, I think, crypto first and then AI. But can that happen again? For sure. Does it affect the penny stock market? I mean, I have no idea.
Because your firm doesn't cover the penny stocks. And
we don't do analysis on any individual stocks. We use index funds and funds from a company called Dimensional Fund Advisors.
Right.
And that's Dimensional Fund Advisors is like an index fund, but they put a little bit more weight in small cap and value stocks. And they're actually not technically an index fund, but they own all the stocks in the market. Like anyway.
What do you think about like geographic allocation? Do you think it's still something important? Because it's been like a few years ago it was really important. Like, oh yeah, you need access to emerging markets and all that stuff. Do you still think it's something that's
I think so.
proven?
I think so. I think the U.S. market it's come back now, but it's had some struggles in the last year or so. And international stocks and Canadian stocks did a lot better over that period. So I think diversification is as important as it ever was. Some people make the argument that because U.S. companies derive their revenue internationally, that you don't need international diversification anymore. But I mean, just in the past 12 months, we've seen that the U.S. market and international markets can perform very differently. Just because the U.S. has international revenue sources does not mean that the U.S. market is as diversified as holding international stocks directly. So we still have, we keep a third of our portfolios for an equity portfolio, about a third in Canada. And the rest, we market capitalization weight U.S. and international and emerging market stocks. But yeah, I think it's still as important as ever. People forget so quickly, like we're in 2026. From 2000 to 2010 or even longer in Canadian dollars, U.S. stocks delivered no returns or negative returns in Canadian dollars.
Yeah.
And especially after inflation. From 1968 to 1982, U.S. stocks delivered basically a 0% real return. Yeah. And in that case, returns were above 7%, but so was inflation.
Right.
But in both cases, international stocks did better. Canadian stocks did better. So, I mean, people forget that these periods can happen, and we've had lower returns.
It's just hard
It
to know.
happened for a long time.
Yeah, it's just hard to know which country. Like I think in early 2000, like Sweden, now South Korea. But how can you know before?
Stocks, Kospi one is crazy.
But it's 2026. So we've had 2010 was the end of the lost decade for U.S. stocks. So we're 16 years into a pretty crazy bull run for the U.S. market.
Crazy one. Yeah.
Crazy, this is historic, nuts. Yeah. Is it going to keep going? Who knows? Will there be another period in the future where the U.S. market does poorly and international and Canadian? Well, we've already seen that more recently. Canadian and international stocks have outperformed the U.S. But will we see a more extreme period of poor U.S. returns? I don't know. I mean, I can't predict the future, but I don't think diversification is ever going to be something you look back on and say, that was a bad decision.
Speaking of when it booms, do you think thematic ETF usually launch too late after the boom?
Yeah, there's a research paper on this that asks that exact question. It asks, do thematic ETFs time their launches in a way that's not good for investors, basically? And so what they do is the answer. And so what tends to happen is that an index gets created for some theme that's hot at the moment. So AI or electric vehicles.
Because 2 years ago, no
or
one
even
was
6 months
talking
ago,
about South Korea ETF, let's say. Right?
Yeah.
Or people were laughing
nobody
at
was
you
talking about it.
Yeah. And so they'll back test an index and they'll say, and I don't know if South Korea is maybe a trickier example because it's not really a theme. The themes are usually Yeah, like electric
tech, let's
vehicles,
say.
crypto.
Yeah, exactly.
Even it's probably even more niche than tech.
Yeah,
Tech is like an
Like
industry,
green
right?
energy, like a few years ago when Biden came,
Yep.
was pretty
Yep.
big.
Yep, stuff like that. And so what tends to happen is that an index gets back tested, and the back test looks great because that theme is hot right now.
Yeah.
And then they launch an ETF based on a really good back test. Then the live ETF, it tends to launch, and this is what the research shows, that they tend to launch at the peak of excitement about that theme, and then everything tends to drop off, and the thematic ETFs tend to have really poor returns for investors.
So is it useful to backtest then? Like, I don't know. It seems like
Well-
for me, the strategy would be to short every new ETF launching.
Yeah.
It depends on your incentives, I guess. For the ETF company, it makes a lot of sense to backtest because
Yeah.
you can sell the backtest.
Right. Yeah. But I mean, for the investors watching the show.
Well, they should just avoid thematic ETFs, I think. Shorting them is tricky because they can be very volatile.
Right.
And so you can get messed up shorting a volatile thing.
Especially the semiconductors one.
Oof, yeah.
Yeah.
That would have been a bad one to short.
I read that your wallet is 100% equity.
Yeah.
Is that it? Right.
It is, yeah.
What would make you change your mind and go to bonds or Bitcoin or whatever?
Probably not Bitcoin. That'd be
I also read you have zero Bitcoin.
I had a little bit for a while.
Okay.
But yeah, I don't know. I'm very comfortable in equities. I don't know what would change that for me.
Maybe if valuation become extreme.
Theoretically, there's a level where the expected return on theoretically it could happen where the expected return on equities is below the expected return on fixed income because valuations get that high. Maybe in that pretty unrealistic scenario, maybe I would change my portfolio, but that I don't imagine that will happen. We can talk again if it does, and we'll see what I'm thinking about doing.
Yeah.
But yeah,
We'll subscribe to your podcast
Yeah.
to make sure we get notified.
But I'm 100% stocks, same as I described before, a third in Canada, the rest market capitalization weighted US and international. And I am using dimensional funds, which are a little bit tilted towards small cap and value stocks. So they own all the stocks in the market or most of them, just like an index fund would, but they tilt away from the largest and highest price stocks and toward the smaller and lower price stocks. And I'm pretty comfortable with that portfolio. I think forever. We'll see if I add bonds
that
one
was
day.
my other question.
Yeah.
If you get close to retirement, would you stay 100% in equities? Like, what would you advise to people?
I think so.
Okay.
And there is research supporting that based on historical data, a couple different papers. I mean,
Is it true that if you switch to bonds, like let's say I'm about to retire, there are some hidden risk doing that?
yeah. So the research that has looked at that question has found that bonds can be detrimental in retirement portfolios. Now, we have to be specific about the types of bonds we're talking about. We're talking about nominal bonds.
Okay.
So we do have in Canada real return bonds, although they're being phased out. In the US, they do have TIPS, which are inflation protected. So this research is talking only about nominal bonds, which are not indexed to inflation.
Okay.
And real return bonds have their own issues. But the nominal bonds, they tend to be riskier because they're very sensitive to inflation. And so if you're retired and we end up with a period of high inflation, nominal bonds can just get wrecked.
Right.
And that can be really damaging to your ability to fund your retirement portfolio. Stocks aren't inflation hedges. They don't go up when inflation is high, but their expected returns are high enough that they tend to outpace inflation in the long
they
run.
could pass the price to customers.
Yeah. So we don't have many retired clients who actually have 100% equity portfolios, even if we explain this research to them, because people still care about volatility.
Okay.
And volatility, even if we can show in a model that it's not the right risk to be worried about as a long-term investor, and we can show that, people still care about day-to-day volatility. And you can say that's irrational, you can say it's wrong, but like if they bail out of their portfolio because it was too aggressive, well, that's also a really bad outcome.
But do you think that's like an education shift that's going to happen later in life? Or because I feel like before, like people were reading the books, it was like, oh, typical 60-40, but nowadays it's like less and less and less something that people actually hear from. And concepts are going to be like, oh, okay, now it's true. Bonds are probably not even useful anymore.
We're not seeing that. And we do, like we've had people who have written this research on our podcast. We've had lots of very accomplished financial economist guests on our podcast who themselves are 100% equity portfolio in 100% equity portfolios. as retirees. We do educate our clients on this, and yet our if we look at our overall assets, our total book of investments is roughly 70% stocks and 30% bonds.
Oh,
So even with that level of education from people who, are comfortable explaining that to people,
yeah, that's impressive.
people still want to hold fixed income. So I don't think that's going to change over time. I think there is a bit of a concern that we've been in a long bull market, like we've talked about. Stocks have been pretty resilient.
Yeah, exactly.
People are feeling
they've known
pretty
other stuff in the
Right.
80s, and
Yes.
they've paid like 18% interest on their homes and
Yeah.
stuff like that.
Yeah, and they've seen real downturns. Like they
Yeah,
lived
yeah,
through
exactly,
2008,
not us.
2009.
You're right.
But younger people who have not been investing for as long, even though we had COVID, which was a big drawdown, but it was
It
short.
was very quick.
Have you seen real downturns? Like, were you invested in 2008 or?
No,
Okay.
I was in university in 2008 on a
He
scholarship.
was in diapers.
No.
I still remember. I remember being very. I was very insulated from 2008 because my parents were teachers. Their jobs were fine. I was on a basketball scholarship in the United States.
You played basketball.
Yeah.
But
Right.
why not basketball? Why finance?
Oh man, I wasn't good enough to play professionally.
You played Division 1, right?
Division 1,
If
yeah.
Wikipedia is right.
Yeah.
Okay.
Yeah. Yeah. And
How good is it, Division 1? I don't know.
It's very good. Our
Okay.
team was I would say a mediocre team in Division 1. We played against lots
That's
of.
nice for the other
Yeah.
players.
He's not gonna sit in the school now.
I
School reunion, then you're out.
I don't think they would disagree with me. We didn't win our conference championship. We were
Okay.
always kind of middle of the pack. We were a good team, but everybody's good.
Yeah.
We played against some big names, which was cool. Played against Memphis, played against UConn, Syracuse. So yeah, that was always fun, and we were competitive. We beat Indiana at Indiana, which was cool. That's like a big name.
Right.
Big name school. But why was I talking about this though?
No, because you chose finance because
Yeah.
you were too bad at basketball.
Yeah, I was not good. I was not good enough. I was not good enough. I would have loved to play professionally. Oh, I had. How good is it? So I had. One of my teammates had a pretty good professional career.
Okay. Who is it?
His name's Matt Janning.
Okay.
Played overseas, not in the NBA.
Okay.
I think he had one NBA 10-day contract. A couple of other guys played in the NBA developmental league. It's called the G League now. So we had guys that went and played professionally. A bunch of other guys played in different countries for a little bit. Matt had the longest career. But even then, all those guys are now retired from professional basketball. So
yeah.
even if I had been good enough to play, I probably wouldn't have played for very long.
Yeah. Do any of them have a successful podcast like you have?
No, I don't think so.
Well, we found one and he's here today. Let's talk about Bitcoin. So you own 0 Bitcoin.
Yeah.
I would like to know what would make you change your mind. What would make Bitcoin investable in your view? You don't have to answer this one.
Oh, I'm happy to answer it. My thoughts on Bitcoin, and I was kind of skeptical for a long time. I was interested because when I was a kid, I read an article in a magazine about the Silk Road, and I read about Bitcoin, and I set up a
This
Tor.
is how it all started.
I set up a Tor browser, and I was like, "Oh, this is cool stuff." And then I just never bought any Bitcoin, forgot about it, whatever.
Did you buy some stuff on?
No, I never bought.
I hope not.
Well, I would have had to buy Bitcoin to do that.
Right.
I never did. And so when its price started going up, I was like, wow, that's crazy. Because I remember it as this weird niche thing that I read about in some random magazine. So I followed it. And then the price went up a lot. It's like at $5,000 at one point. I was like, oh, I've got to start paying attention to this now as a finance person. But it was still this kind of weird thing. And then the tipping point for me and for us at PWL was when we had Professor Campbell Harvey on our podcast. And he is like one of the most accomplished financial economists that exists. Tons of great research in traditional finance. And he became this like crypto bull. He was.
Oh, okay.
And so we had him on our podcast. We spent an hour talking about his traditional finance research. He's done a lot of stuff about emerging markets, international diversification. I can't remember what else, but great conversation for an hour. And we spent an hour talking about crypto. And
you didn't expect that, right?
Well, I knew he would talk about that because he had just written a book on DeFi. So we planned to talk about this.
Okay.
When was that? Like a few years ago? Or?
It was a while ago, yeah.
But you didn't expect him to be as bullish as that.
I didn't expect him to be as convincing as he was.
Okay.
And so I listened to him and part of it's his credibility. Like this guy is way smarter than me. He knows way more about finance than I ever will.
But this was the tipping point of switching against Bitcoin?
No, it was
okay.
about taking it seriously.
Okay.
And so, and this was, I can't remember when it was, 2020 maybe? the first time that Bitcoin hit 60K. It was like a little bit before
Yeah.
that or around that same time, because
Yeah.
then it crashed and it came back. And so after we talked to him for an hour, and we talked to him for probably half an hour after we were done recording too. And Cameron, my co-host, and I, we looked at each other. Okay, like at this point, we have to take crypto. We have to at least look at it seriously.
Yeah,
we
yeah.
can't just ignore it anymore. And so we ended up doing the way that we took it seriously is we did, I think it was like 15 or 16 special podcast episodes. So we started for a couple months. We released 2 podcast episodes a week, where one episode was normal, one episode was so focused on crypto.
Okay.
And we had a bunch of guests with different levels of expertise in different areas that touch crypto, like the computer science perspective, the economics perspective, the legal perspective, just all these different interesting people that had done very specific research. We had one guy who was a software developer who spoke to how blockchain, what problems blockchain actually solve, which was super interesting. So we tried to piece together, like, what is actually going on here and what does it mean? And we came away from that, I think, more skeptical than we'd gone into it. And so we never ended up investing in it. The price went up a lot after that.
Of course.
as tends to happen.
Yeah.
And the worst part is when I decided after we talked to Cam Harvey and I was like, okay, we have to take crypto seriously. I went and bought, I think, $1,000 each of Bitcoin and Ethereum. And that was like at the peak of that period.
Usually what happens.
And then I sold it at the bottom. I was like, I'm done with this stuff.
Perfect
And then it
timing.
went back up again. I was like, oh man, come on. But yeah, my main takeaways were that it's an interesting technological innovation. Like it solved a problem that had not been solved before, like the double spend problem that digital cash always had. It did it in a way that's pretty interesting. They called it trustless. I don't know if it's totally trustless, but it moved the locus of trust to an area that had not been really played with before. And it created this asset that has a lot of ideological meaning for a lot of people. And I think that's probably the most interesting part about it. I think as an economic innovation, it's not actually very useful. I think as a technological innovation, it's interesting, but because of its it's questionable economically. I don't know if it's actually that useful. It's interesting. I don't know if it's useful. I think where it has landed, in my opinion, is it's a form of ideological expression. People who believe that the government should not touch money, people who believe that money is a certain thing, and there's a whole other ontological debate about what money actually is. Is money a thing, or is money an idea, a social construct?
Yeah.
Bitcoin, I think, and the way Satoshi wrote the sort of announcement about Bitcoin, viewed it as money as a thing, and so it's this asset now where if you hold those beliefs, you can buy it and you can feel really good about it, but that's really its best use at the moment.
Yeah.
Is
And
my-
with
is my
quantum, that is
Well, there's
around
quantum,
the
but there's
corner.
also, man, just the cold card stuff. Like you look at the way that a bunch of people were hacked recently because the way they generated their seed phrases
not random
didn't
enough.
have enough entropy. And it's like, okay, it's not the future of finance. Clearly,
Yeah, right.
if people generate
That
like
was like 2 weeks ago, right?
is still ongoing
And
now.
as people get older, let's say they get Alzheimer and they forgot their passwords,
Yeah.
like
It's
screwed.
it's
I don't know.
crazy to me. Like
Yeah.
the idea that, and I think, and again, it comes back to the ideology of money. And I think that it spoke to a lot of people who held certain ideologies about money. And that's one of the reasons that it got to where it is today and why its price is still hanging
Yeah.
on. But practically, like the idea that it's going to revolutionize finance and change the world, I think we're well past that being the reality.
You should mark this episode. It's going to go up.
Yeah,
after
probably.
that.
100%.
Skyrocket, and we're going to do some clips about it and memes. Let's talk about dividends. Why are investors emotionally, like you said before, like covered call is very emotional, dividends really emotional, even though a dividend does not create any additional wealth?
People have, and this is a well-known bias called the mental accounting bias. People have a preference for income.
Right.
And I can call that irrational. I can say it's dumb. I can say it doesn't make sense. I can say it's inefficient, but like people want income.
Free money coming in.
Yeah, it feels like free money. Even if we know it's not, it feels
Yeah.
like free money. And that's really hard to argue with.
Yeah.
The thing that I think is really interesting about dividends is that if being a dividend investor actually makes people behave better, because they're not going to sell their portfolio because they feel like they're still getting the income.
Yeah, that's a good.
It's maybe
point of
not
view.
so bad.
Yeah, yeah. But the joy of receiving it, it's like receiving each day or each week a package from Amazon
Yeah.
at your door, right? It's
Yeah.
like you receive something from Santa Claus
Yeah.
or whatever.
And I know investors who are in sort of my podcast community and comment on my stuff. And even though they get the dividends don't matter and that it's not increasing their wealth, it's just changing the characteristics of their wealth, they still love receiving dividends
Yeah.
in their brokerage
It's
account.
really popular. We're going to receive a guy called the Dividend Guy on the podcast. He's doing all the podcasts in English, but he's a French-speaking guy from Laval. So he's going to come
Yeah,
on the podcast.
I don't think he's a fan of mine.
Oh, you know him?
Just from the internet. But,
Okay, well, that's nice. We're going to do editing like in the same
confrontation.
episode. I know we've talked about private equity, but I see more and more private equity firms. My apps were acquired by a private equity firm as well. Is it less volatile, or is the volatility simply hidden because nobody is marking the assets to like every day?
Yeah, I think it's this. I think it's the second one. I think it's masked by the lack of liquidity. I think the underlying values of private equity are at least as valuable, volatile as public equity, and probably more comparable to like smaller cap companies. So even more volatile than like a stock
But you cannot
market index.
access and see them in real time, so you feel safer, let's say.
But if you try and go and sell them at their current marks, there's a good chance you won't be able to.
The spread will be big.
Well, if you can sell them at all. And this is the issue that has happened now for investors over the last couple of years is that they had these marks on their private assets. They thought they were worth this much. And they said, okay, I want to redeem now because I think this space is getting riskier. Yeah. And the PE funds are saying, and the private credit funds and the private real estate funds are saying, well, no, you can't have your money back.
Right. It's like the startup who says like, I'm going to raise at 50 million. So my valuation is 50 million.
Yeah.
Well, not really.
Yeah,
I invested in 3 startups, and in one of them, it's going very well. But then I learned that someone will buy me out. Let's say venture capital at let's say 3 or 4x. I don't know. But then I was like, okay, that's kind of the only way I get my money back, right?
Yeah.
This or going public, which is not happening.
Yeah.
So I either get kicked out with a few multiple or I lose everything.
Yeah.
So it's not very interesting as a investment, let's say.
Yeah.
Okay.
And I think it's been sold to investors on the basis that it is less volatile. There are some firms in Canada who are in my space who have made claims about that, about not being exposed to the same risks as public markets, when in reality they are exposed to the same risks. You just don't see it in your.
If we look at the way the pension funds are investing, like CPP, I think like teachers or whatever, like they're all investing in real assets too. So the idea is it's still kind of a diversification, right?
Well, yeah, they say that.
What's the point of like La Caisse de Dépôt or all these guys of investing on?
I think that's a legitimate question. What is the point?
I mean, you've saw it.
But is it political? Like they have to invest that much percentage there in the economy,
No, I don't. It's not that. I think with large institutions, there are incentives for management to make the portfolios more complicated than they need to be.
Exactly.
Because it justifies their role. Now, like I have a lot of respect for CPP investments. They have underperformed. They
teachers have done pretty well.
Teachers has
the
done
best one in Canada.
Teachers has done better. Benchmarking them to a risk appropriate benchmark would be interesting. CPP used to benchmark themselves against a reference portfolio, which has been very interesting to track. So prior to 2006, CPP investments just used index funds.
Okay.
And after they switched to active management in 2006, 2007, they kept that their old index portfolio and they used it as what they call the reference portfolio.
Oh, they changed the benchmark.
Well, they eventually did that too, but they had the reference portfolio until I think it was last year. But we could very easily check because they report it every year. How is CPP Investments doing with their active management relative to their previous portfolio of index funds? And they've underperformed. So
what's the idea of having all this?
Well, the argument that I could make against what I'm saying is that, yes, they've underperformed, but public markets could crash tomorrow.
Right.
And if it is true that they're more diversified, which I think is a legitimate question that would need to be investigated, and we'll know when markets eventually do drop. But if it's true that they're more diversified and they perform better in a downturn than the public markets, then it was justified, even if they underperformed over the last 20 or so years. But yeah, and then they did switch their benchmark. So they used to benchmark against this reference portfolio. They then changed to a benchmark portfolio, which instead of just being the index funds that they used to invest in, they used indexes for each asset class that they actually invest in. And I think they adjusted it for leverage and stuff because there's leverage in the portfolio. But they tried to make a benchmark that's more reflective of the actual portfolio.
Yeah.
Which is interesting because now they're benchmarking against their ability to outperform in each asset class, but they're not really benchmarking their asset allocation. They used to be saying, we could have invested in index funds. Now we're investing in all these alternative asset classes. Was that a good decision? And now the current benchmark kind of assumes that the asset allocation is right, that they should be in all those alternative asset classes. And now we get to see whether they're doing a good job within each asset class.
It's so complicated just hearing you talk about it. Like
on that subject, I was just wondering, is there any studies, or have you looked at, like, if you look at Brookfield Renewable, for example, was it more valuable buying the stock or investing in one of those private funds?
Oh, I have not looked at that. But that would be
very interesting.
That would be interesting.
Yeah.
You talked about scam because you're targeted about scammers with impersonating you through WhatsApp. We live the same. We don't have any WhatsApp, any Discord, by the way. How can we be sure that today we were with the real Ben Felix?
I didn't fit through the door.
That's a good point.
Yeah, that's a good one.
And what was the password? When I go get the kids at the summer camp, they ask me for a password.
Oh, yeah.
I didn't know the password, so I look like, let's say, illegit. What is like to have basically criminals weaponize the credibility you spent like years building?
It feels terrible, and I feel helpless to combat it. Like there's literally nothing we can do. I don't know what to do about it. Like I did a video on it to tell my
you
people.
Blue check yourself.
But you can do that, yeah.
know,
but even then, people create now on Twitter, at least you can create a blue check so easily. So people can create a blue check and use my name and whatever. It's like it's so easy to impersonate somebody. People post comments in my YouTube videos that direct people to the WhatsApp groups, and that there's all kinds of stuff like that. But we've had people call our office saying, like, I'm in a WhatsApp group with Ben Felix. I just want to confirm it's the real Ben before I buy the stock. And they're like, no, it's not the real Ben. Like, he's not on WhatsApp. So it's terrible. And I don't like it, but there's not much. I mean, you guys know there's not much we can do. It's the platforms like WhatsApp and Twitter and YouTube and it's not, YouTube's not so bad.
I do talk with them. Like I kind of make myself like, hey, come get me. Like, and then I wanted to know like how far it's gonna go. I even joined. Oh,
I did that too.
Yeah,
I did a video about it.
Just to have the tips. Maybe it's good.
I was in a WhatsApp group with it was a group, but then I ended up in an individual chat with the scammer that was impersonating me. So I'm chatting with like myself.
You changed your name, of course.
Yeah. I changed my name and I made
Felix Jr.
I did
Felix Bam.
I can't remember what I used as a name.
So clever.
But they wanted me to buy this specific stock. Like
but why are they making a commission?
So I was trying to figure that out, and when I watched the trend of the stock price over time after they started telling me to buy it, I'm pretty sure it's a pump and dump.
Oh.
So you get a bunch of people to buy the stock. They own the stock. They get a bunch of people to buy it, then they sell. Yeah.
Oh.
Crazy.
I'm pretty sure that's a scam.
So do you think that's the main way to monetize? Like,
I don't know.
Did they ask you to send $5,000 to some uncle that needs money
just to buy the stock?
Okay.
It's actually easier to sell this idea than asking for money.
Yeah.
Yep. And you can probably make more money.
Yep. And then it's just
like, buy the stock?
No, I didn't buy it.
I think I'll go down.
But it was crazy. It was crazy to watch it because it popped up and then it crashed.
Yeah.
And I watched it like over the course of a week or so. I watched it happen. I was like, okay, it was a pump and dump. Now I know what they were trying to do.
Yeah.
Yeah, it's terrible.
But there are many groups like that. And that's why I feel like penny stocks, it's dangerous.
It's one of the reasons.
Know how they also pump with Google ads and stuff like that.
Yep.
Yeah.
Oh, okay. Well, do you have any other topic? Do you want to practice French before you leave? I mean, we still have some time, right?
My level of French is 0, guys. Like
Zero.
I wish I could practice.
You cannot say
Je m'appelle Ben.
Benjamin.
Benjamin.
Yeah, exactly.
That's like all I got. My kids, you'll be glad to know, they're in an English school where I live in
Well,
Quebec.
I'm not paid by the government,
No,
so
but
I would not
but-
be that
well,
glad
it's,
to
you
know.
know, we're
It's nice.
it's usually a podcast in French, so
Right.
I'm sure people would like it.
Yeah.
My kids all speak, I would say, conversational French. So
Okay.
we do live in Quebec, and whenever someone doesn't
Do
speak,
they swear in French?
I don't know.
They don't, it's not conversational then. Then they lack half of it.
But they'll be my interpreters
Yeah. Okay.
if someone speaks no English. But
We're gonna do like the mid roll in French. You can stay if you want.
sure.
If you don't want, we'll.
No, you go ahead.
Well, thank you, Ben.
Thank you so much.
To be here today. It's been a pleasure.
Yeah, thanks a lot. I had a lot of fun.
Thanks National Bank, Banque Nationale. Merci de nous supporter encore une fois. Et à la semaine prochaine.
C'est bon, ça. Short and sweet.
Short and sweet. Merci, Ben.
Great.
Merci beaucoup.
Yeah, thanks a lot, guys. That was a lot of fun. Good questions.